Hey everyone, Nike is scheduled to report its next quarterly earnings results on Thursday, June 27th after the markets close. So investors are curious, should they buy Nike stock before they report earnings, after they report earnings, or don't buy Nike stock at all? I'll answer that question in this video, looking at the company's latest prospects, and I'll review what investors should look for from Nike coming up in their quarterly earnings results. So let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so year to date, Nike stock is underperforming. It's down 12.8% so far as of this recording. One of the reasons Nike's stock price is down is because revenue growth is down, and that led management to a minor restructuring where it will cut some costs, cut some employees, and change and adjust their strategy on the margins to improve growth and improve profitability going forward. Now, I highlighted revenue growth has stalled. In the third quarter, revenues were flat or slightly up from the same quarter the prior year. Longer term, if you go back the last decade, Nike has consistently grown revenue. Well, not consistently, but Nike has grown revenue on average about 8% year over year for the last decade or so. The flat revenue is troubling for a company that grows at roughly double digits or close to double digits. One of the strategies I highlighted it's going to change now or adjust on the margin is its relationship with wholesalers. Wholesale revenue in the last quarter was up 3%, and that's Nike going back to wholesalers now. In the years before and during the pandemic, Nike really focused on its direct-to-consumer strategy, cutting out wholesalers, wanting to get directly to its customers. And the reason it did that is because it can generate higher profit margin if Nike sells directly to customers. It cuts out the middleman, and so it gets higher prices for its product. That strategy really paid off during the pandemic because, remember, there was inventory shortages everywhere, and customers were spending more than usual. And so the confluence of factors really worked in Nike's favor during the pandemic. During the initial stimulus benefits afterwards and the lockdown periods afterwards really helped Nike, and its revenue exploded, its profit exploded. But now, as economies reopen and as customers go out of the house more, Nike's direct-to-consumer strategy is a bit of a headwind because customers are going out more, they're going to stores more, and they're seeing fewer Nike products in the stores they visit, like Foot Locker and Macy's. And so with fewer products available at these third-party retailers, Nike's sales have flattened a little bit as consumer spending has shifted from online spending, which favors Nike because it has a robust website, a great app, and it helps its business when people are shopping online more often. Nike doesn't have the thousands and thousands of physical brick and mortar locations. It has some direct-to-consumer locations, but not as robust as its third-party network really widens that reach. And so management is now shifting a little bit, saying, okay, let's bring back some wholesalers because we have more inventory available now. We don't have shortages, and so we have more inventory to go around, and we need these partners to help facilitate sales. And so they're shifting that on the margin, but still their profit margins have done well. Gross profit margin increased another 150 basis points in the latest quarter to 44.8%, and that's including the detriment of 50 basis points due to those restructuring charges the company undertook because it needed to cut costs and shrink its business. So now incorporating those wholesalers should provide a little bit of a lift for Nike's sales. And if wholesalers, take back Nike without hesitation, because you've got to think about that other side of the equation. Are wholesalers going to come back to Nike and say, okay, we'll welcome your products back? Or are they going to say, well, you tried to ditch us, and now that you feel like you need us, you're trying to come back? We don't like that type of relationship where you just use us when you need it, and then when you feel like you can ditch us, you just exit that relationship. So that's a question mark. I'm waiting for resolution. Or the wholesaler is going to return to Nike? And does Nike still have that negotiating power because its brand is so powerful that wholesalers just have to accept whatever Nike has to offer? And that's partly been true for some businesses. I mentioned Foot Locker earlier. Foot Locker's sales really got hurt when Nike pulled back its inventory from that retailer. So there is evidence Nike has strong negotiating power there. Another thing Nike's really good at is advertising. And I like when Nike's ad marketing expense increases because they've demonstrated skill in marketing. So this is an area I don't mind Nike spending more on. They increased that by 7% in the latest quarter, up to $4.2 billion. And I highlighted Nike saying they're making the necessary changes, adjustments to drive Nike's next chapter of growth. And I think adjustments is the right word here, because that strategy with wholesalers, they're not completely going back on that, direct to consumer strategy where they're focusing more on connecting with customers rather than having third-party retailers make the sales to customers. But they are just adjusting it on the margin, adding a few more retailers or adding a little bit more inventory to existing wholesale partners, while still maintaining that strategy where they're trying to get more customers to download their app, visit their website, open a Nike.com account. And so Nike can really deepen that relationship with its customers rather than have third-party retailers make those sales and retain those relationships. But on the margin, just to generate a little bit more revenue, they are making adjustments. And I think that's prudent here from Nike's management. Now, Nike stock is trading at a forward price to earnings of 21.59. This is the cheapest this stock has been in a very long time. When measuring by this metric, Nike stock has never been cheaper in the last 3.5 years, going back before 2021. And that's partly the reason I've had Nike stock rated as one of my top 25 growth stocks, or I should say top 25 stocks, and one of my top 10 dividend stocks to buy in 2024. So far, that recommendation has not worked well. It's been one of my underperforming recommendations year to date in 2024. You can see here I've also had NVIDIA as one of my top stocks to buy in 2024. This recommendation has worked well, and the Nike recommendation has not worked well. But in this video, to answer the question, should you buy Nike stock before earnings or after earnings, or should you buy Nike stock at all? And I would say I'm reiterating my recommendation that Nike is a top stock to buy. And I would be indifferent buying before or after earnings. Typically, I caution investors against buying a stock before earnings because it's more volatile. But in this case, I feel Nike stock is undervalued enough where if you want to buy before earnings, it's okay. If you want to buy after earnings, it's also okay. I think the most prudent would be if, let's say, you have $1,000 you're willing to invest, you split it up and you say $500 before earnings and $500 after earnings. And that way you split up your risk. You split up your risk of missing out, and you split up your risk of getting in and then the stock price crashing after earnings. So there's my thoughts. I still like Nike stock at current valuations. I like the risk versus reward. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.